All right, let's welcome Jeff from Upstart.
Sorry for the delay there. In addition to running growth for Upstart, I'm also the Chief Information Security Officer. So I've got a nice 35-character randomly generated password and two-factor authentication to get in and actually show you what the site looks like. So I apologize for the delay. So I'm Jeff. I'm head of growth at Upstart. We are here to talk about kind of a new product. You may know us. We've been on the market for about 2 years with an income share agreement product that allows people to raise capital in exchange for a fixed percentage of their income over 5 years. But what I really want to talk to you about today is a new product we launched, which is a term loan. And so what we saw from a lot of our borrowers was that there was this massive underserved market of people with relatively thin credit files that were completely underserved in the market. And we thought, can we take what we've been doing in our income share agreements and use it to expand upon traditional underwriting to serve these guys with more traditional loans? And so we've taken government data sets, commercial data sets, more than 1 million data points to build an underwriting model that goes well beyond credit history and FICO to actually serve these people. We've got a platform today open to do accredited individuals and institutions, but not non-accredited investors. So what we found really when we looked into this is that traditional approaches to underwriting totally underserve thin file borrowers. Right? If you look at Lending Club, the big player in the space, they reject 9 out of 10 applications proudly. The number one reason is short credit history. Less than 2% of loans go to people with less than 6 years of credit history. So you've got this kind of very large number of people who are completely rejected on the platform. They also, most of the traditional P2P lenders completely prohibit use for educational purposes. Right? These aren't student loans, but you'll find that there's a large number of people going to $10,000, 10-week training programs that need student-oriented loans to pay for those and have very great educational outcomes. And the third thing was those people who did apply and did qualify were given very high rates because we as an industry, as the lending industry as a whole, not just P2P, tend to think of young as risky. But inherently that can't be entirely true, right? So there's a report recently by the Federal Reserve Bank of Richmond that said young people in their 20s were less likely to experience a serious credit card default than older borrowers, which runs counter to your intuition. But at the same time, it must be true that among the 20-year-olds today are the prime borrowers in their 30s and 40s. The question is, can you figure out how to find the best borrowers in that pool and separate them from the borrowers who are very high risk? And so what we've done is actually built an underwriting model that takes a look at a whole bunch of factors outside of traditional credit history. So we look at where'd you go to school? What'd you study? How'd you do? What's your SAT score? Believe it or not, SAT score is one of the most important pieces of information to know if you want to predict someone's income. Right? If you want to predict their willingness to pay a loan. The SAT score is actually one of the most predictive pieces of data you can find. And so we take these things and we add them on top of traditional credit metrics. We do traditional credit metrics as well, but the closer you are to school, the thinner your file, the more important the education metrics become to finding the really quality borrowers. And using these things, we're able to give better rates to people. So here's a great example. I've got someone recently out of school, 3 years, making $55,000 at 680 FICO. So when 8 years out, it's a little older, a little more money, a little bit better FICO score. Probably gets a lower rate, right? They look like a better borrower. Then I've got someone with 1 year credit history, they get no rate from anybody. But by looking at their backgrounds, I can put faces to names, I can put faces to profiles, and a little bit more information. So I look at 3 years credit history, just graduated from a great school with a great GPA. They're in a growing industry. They're very likely to remain unemployed, and if they lose their job, they're very likely to become employed again. Right? So this person actually deserves a pretty attractive rate. I see someone who's farther out of school that looks like a more attractive borrower on the surface, but a Russian literature major from Wyoming State University, if you become unemployed, are there any Wyoming State Russian literature majors in the room? Okay, I'm not going to insult anybody. Is not as likely to become reemployed, right? So actually maybe a higher risk borrower in some ways than traditional metrics would indicate. And I got a guy here 1 year, no credit history. Right? But what's he got? He's got a CS degree and a job offer at Amazon. That's a pretty good bet. Right? And so by going beyond traditional credit metrics, we can really start to underwrite people differently, give more attractive rates to the quality borrowers, and make a really compelling product. We also think over the last 2 years in our income share world, we've built a really strong brand that's really around helping recent grads launch their careers and launch into their lives. And this plays very well into what we're doing today as well. Right? We're still really giving people early in their careers access to money. Maybe it's to pay off credit cards. Maybe it's to take a coding course. Maybe it's to move across the country to start their first job. But we're really focused on the recent college grad set and how we can give them access to capital in a way that they traditionally have been blocked out of it. And so we have launched a 3-year installment loan, $5,000, $25,000. You can see all the stats here. This is a pretty typical product. The real differentiation is in the underwriting itself. So I wanted to show you guys real quickly. Well, I got 2 minutes left. I got a little clock up here to tell me how I'm doing. Kind of what the platform looks like today. And so today you can hop on. You can see a variety of loans available. You can see the backgrounds of people, where they went to school, so you can get a lot more information that's relevant to someone than traditionally is available. I can hop into a loan. I can actually start to see where they go to school. By the way, we do verification of everything that goes into our underwriting. So if you tell me you went to the University of Pennsylvania and got a bachelor's in political science and you have a 34 ACT score, I actually verify all that information. And then again, we can use that to underwrite this person's interest rate. You can see a very attractive interest rate to someone who's not as far out of school. And that's really based on the data we've been able to correlate from educational background to your willingness to pay a loan, your ability to repay that loan. The other thing we did from an investor point of view that was really interesting is the ability to actually create rules and auto-invest automatically. And so one of the things, having learned from people in this space, I can very easily as an investor create a rule. I can pick risk grades, use of funds, interest rates. This stuff is invested automatically. There's no race conditions. I was hearing last night about HFTs and how this is going to become a who can get closest to lending club servers game. We really want to level the playing field and give everybody access to loans on the same terms, so any investor can go set up automatic ACHs to invest and automatic rules to invest in loans as soon as they become available. And actually, we'll do a 24-hour period where anybody who bids to invest in a loan will be given an equal shot to invest in that loan. So there's no kind of race conditions on who's going to get there first and pick up the loan. And the last thing I want to say is we didn't get this announcement out quite this morning, but we actually announced just today the first institutional capital coming to our platform specific to the loans product. Ranger Capital will be investing in loans on the platform. This is very exciting for us. This product's been in market for 2 weeks, and we're already seeing a lot of traction and interest from both investors and borrowers. So that's Upstart and what we're doing here at LendIt. Thank you, guys.
We have a couple extra minutes. Is there a question that anyone would like to ask Upstart today? I know, it's okay. Let's do one.
Robert? So we're talking to the guys who run the SAT and the ACT to try and get automatic pulls. We're also talking to the schools to get automatic transcripts electronically. Right now, we actually have to have the students get them and do a verified push. So it's not as great as it will be, and we'll have to improve that automation over time. Yeah. We've done a lot of stuff in the income share world, working with schools, working with the coding programs that are kind of alternative educational purposes to find us. We're looking at everything that everybody else does in the space, direct mail. We've got direct mail that's going out now. But frankly, we found that our borrowers, because they're millennials, are much easier to find online, right? So Facebook targeting is really compelling for me because I can find people who graduated from decent schools in the last 5 years and make them an offer directly through Facebook. And so we're finding a lot more digital channels that have much better targeting for our target audience. Yeah. We haven't really gotten into that yet. I mean, I'm sure, like I said, we announced this product 2 weeks ago, so we haven't really explored the secondary liquidity space, but I'm sure if you call me in 6 months and we'll have a different answer for you. Yeah, one more question.
I have noticed that you're doing deferrals on the payments.
Yes.
Is that only for students still in school, or?
The deferrals are really built. We have 3 and 6 month deferral options on the loan product. Those were really built with the alternative education experiences in mind. So the coding boot camps are generally 10 weeks long. They cost 10 grand. You come out. Generally, people are going from $40,000 to $80,000 to $90,000 in income. But they need to not make payments while they're in that program because it's a 40 to 60 hour a week program. So it really was built for that. It won't be limited to those people. Interest accrues during the deferral period. But that was really the purpose, was to allow some of these non-traditional educational experiences. And by the way, these are great programs, but they're not accredited, so you can't get a student loan. And they're educational uses, so you can't take out a loan on Lending Club or Prosper because they ban educational uses. So there's this really nice market. They expect 6,000 graduates in these programs this year, $60 million in tuition. We wanted to make sure we were going to serve that market as well. Secondary liquidity.
Is the vast majority of your, quote, non-traditional credit scoring data all related to education-related data?
The vast majority of it is today. We look at some income history data as well that goes beyond what's traditionally a credit report, but a large portion of it is educationally related data, yes.
Let's do one more question.
One more question here in the back. Thank you. So we've made the minimum from an accredited point of view $100. I expect that to be a relatively small number of people, but particularly in the income share world, we wanted to make sure that people who are interested in checking it out and seeing how it worked had a way to do that without putting more capital in play. The average investor puts well more than the $100 minimum on the platform, but we wanted to make it as open and accessible to an accredited investor who wanted to try it out as we could. Thank you guys again for your time.